Hello and welcome to the Index Investor. Today, we're taking on one of the oldest debates in investing, active versus passive. And to help us decode this, I'm joined by Mukesh Jindal. He's co-founder of Alpha Capital, and my colleague Siddhant Madhav Joshi. He's a mutual fund analyst at Value Research. Welcome, gentlemen.
Thank you, Ruchira. Thanks for the invitation.
Great to have you both here. Now, Mukesh, let's begin with the basics. What's the real difference between active and passive investing, and how do these two reflect such different philosophies? If you could elaborate on that first.
Sure, Ruchira. There is a lot of news about active passive these days in India. Passive is, of course, becoming very big. But for the benefit of everyone, we'll just want to give a background that what exactly happens in active and how a passive different. Yeah. In active, of course, we go to a fund manager or a portfolio manager and we tell him that, you take the money from me and you invest in stocks and sectors where you find value and deliver me the return. Historically, that has been the trend, and active has been very big globally as well. In passive, what happens, we say that, okay, I don't want to go to the fund manager because I'm not sure whether fund manager will be able to give me good return. So why not go to a passive index fund which will purely replicate an index return? So there could be a passive index fund of, let's say, Nifty, which is only replicating the performance of Nifty, or there could be mid cap, small cap. So over here, what happens is that investor gets the index return, which may be good. And because in active, a lot of times, some fund managers, they are able to give better return than the benchmark. Sometimes they underperform. Of course, passive has its own advantage that, they come with a low cost. Now, it's also important to understand, Ruchira, the history of the mutual fund industry and globally what has been the balance between an active and passive. Because it's only when you look at the history, only when you look at the global markets, you get to see a trend.
Yeah.
And that's why you're able to connect the dots. So, the first mutual fund came in the year 1924. In fact, we have completed 101 years. It's 101 years of mutual fund. That's a big time. And first passive mutual fund came in the year 1976. It was launched by Vanguard. Even that is going to complete 50 years. But passive funds became really big from 2009 onwards. Before the great financial crisis, the passive funds were not so big. And today in US, the passive funds constitutes almost 52% of the total mutual fund industry. It's the largest in US. In Europe, it's around 25%. In emerging markets, it's around 14-15%. China is at 12%. And India, we are at 17%. So we are closer to the emerging market index. So I think the space is there to be for both of them, for both active and passive. I think they're going to be here.
Right. So as you said, Mukesh, the case for index funds, it often begins with the cost. Why do lower fees give passive investing such a powerful long-term edge over most active funds?
See, what happens, Ruchira, again, we need to understand that, how did this happen? So earlier, all the portfolios had active mutual funds where we used to give the money to the mutual fund manager. Now, before 10 years back, or maybe, in the 2010, the decade of 2010, the fund managers, the active fund managers were able to create a lot of alpha. Alpha by alpha, I mean, how much extra return the fund manager is able to give over the benchmark. And the alpha could be even in the range of 5-6%. So investors were comfortable in paying a fees to the fund manager, which generally would be in the range of 1.5% to 2% to generate that alpha. Now, globally, what we are seeing is that alpha is going down. It is becoming extremely very difficult to generate high alpha. Even those fund managers who are delivering alpha, beating the benchmark, the gap is not a lot. It's 1%, 2%. It's not that they are able to generate a extra return of 5% or 10% over the benchmark. So when gap comes down, the cost becomes important. Because let's say in a passive fund, today you have passive funds available at a cost of 0.1%, 0.15%. And the active fund is charging you 1.5 to 2%. So straight away, when you invest in an active fund, you are starting with a minus of 1.5%. So a fund manager has to deliver at least 1.5% to match the benchmark return. And higher the cost, it becomes extremely more difficult. In fact, earlier, the active funds in India used to charge 2.25%. Over a period of time, SEBI has been reducing the fund expense, especially because they've come out with a clause that if the fund size is big, then the expense will come down. And recently, they have come out with a proposal that cost will further come down by 0.15%, which I think it's in the right direction, because it's becoming difficult to generate alpha. Now, the question mark is, why is it difficult to generate alpha, and is it difficult to generate everywhere, in all the pockets, or there are limited pockets where, alpha is really not coming? So, if you look at the market and if you try to understand about it, now alpha, it's becoming difficult to come because of something called market efficiency. So earlier, the information of a particular company was available to limited people. Let's say today, if something event happening in HDFC, a fund manager would meet a promoter or the CEO or the CXO of the company. He may get some information which was generally not available to the public, because these fund managers, portfolio managers generally have a lot of access to the top management. They do plant visit and other things. They used to get a lot of insider information, which they were able to take advantage. Now, because of SEBI, restrictions, the information has to be immediately made public. And because of technology also, any event happening in any company, it's available to everyone. And with AI, the information becomes available much faster. So the gap, what I call is information gap, is reducing. And see, alpha or return in the investment business is nothing but information. The person who has the right information or who has the right trend is able to do much better than everyone else. So that information edge is coming down because of technology. And what is also happening is, we have something called algorithmic trading, which is becoming very big. Big hedge funds, big, algorithm driven. And I think after AI, it will only become big. And because of which, what we are seeing, especially in the large cap space, the alpha is getting dried out.
Right. Siddhant, I'd like to get you in this conversation at this point of time. So beyond cost, market efficiency, it makes it hard for active managers to keep beating the index, like what Mukesh mentioned. So as markets mature, are those opportunities shrinking even further?
Well, right. First of all, thank you, ma'am, for having me on this panel. And as Mr. Jindal very rightfully said, like how market efficiency works and what is market efficiency. So basically, as Mr. Jindal said, that as the information is getting more and more democratized, and as it is getting so instantly getting on your feeds, and you are receiving all the updates that the company is having, like not just quarterly results, but what is their analysis on them, what is the management's commentary. So all of that is almost instantly getting priced in the market. So before you or I or even any fund manager tries to act on that, the market has already priced in those information, and hence finding those low cost bets, or I would say those discounted stocks, that is getting more and more difficult, and especially in the counters that have quite a lot of liquidity, like your large caps or mid caps. There, because the coverage is more, and because there is more analysis on that constantly, because of that, the alpha generating possibility for any active manager is shrinking day by day. So I would say that market efficiency is the most lucrative thing that is in the I would say argument for passives, and because of that, I think anyone should go passive and save on your costs, I would say.
Siddhant, looking at the data, how have index funds stacked up against active funds across different market cycles, like bull runs, corrections, sideways markets? What does the evidence show?
So there is a lot of market data publicly available, and many of our in-house studies have shown that how the trend has been. So right now, for the viewers, I would be showing a graph where you are basically seeing that we are looking at a 5-year rolling return period from your January 2012 to September 2025. And here, what we are seeing is that the large caps, which were once showing very decent performance around 2015 to 2016, where around 70 to 73% of large caps were beating the Nifty 100 index. But now that scenario is constantly changing. Like coming to 2020, this outperformance percentage, I would say, has reduced to around 15%. Because of this, we are seeing that the trend is constantly going downwards. The similar thing, we can see this in mid caps as well. Like in mid caps, around 2014 to 17, around 75 to 80% of funds were outperforming. But the recent data shows that only 20 to 30% of mid caps are actually beating their benchmark. And this is not one in point data. In fact, it is a 5-year rolling return data, which shows the consistency as well. However, small cap category has somehow been better off than mid cap and large cap, but the trend is similar only that from a decade ago, the outperformance percentages are constantly coming down. So I would say as more and more market becomes efficient, we are going to see this trend to be sustainable. And I would say that the index funds, which were earlier, I would say, underdogs, and people were not looking at them, but they are slightly becoming the benchmark that most active funds try to beat.
Right. Now, Mukesh, that's the numbers side. But behavior, it often tells another story. Why do most active funds underperform over time? If you can elaborate on that. And is it just the higher cost, or do human behavior and trading activity that too plays a role there?
So, of course, Siddhant explained the data, and he also explained about the large cap. And see, as I was saying, that the passive funds have been globally there for the last 50 years.
Yeah.
And India, of course, we are seeing still a nascent industry, because the market share is only 17%. And a lot of time what happens, like Siddhant explained about the 5-year period, and 5-year period, we had a bull run. And, in a bull run, generally the passives will always do better, and I'll come to that. But historically, if you look at the US markets, specifically the large, mid and small, the large caps are not being able to beat. Almost 90% of the large cap funds underperform in the US. And in the mid and small in the US, it will be in the range of 70 to 80% underperforming. What is interesting is that in emerging markets, and in a country like India, large caps are still not able to outperform, index up to 70 to 80%. But mid and small is where, the value still comes at, there's a chance of 40-50% of the fund managers, they are being able to beat the benchmark. But in a country like India or other emerging market, where I think India is like, for example, land of entrepreneurs. There are so many businesses coming up. Even now, you look at, there's so many IPOs coming in. Now, even smaller companies, they are growing much faster and able to generate higher earning growth and even higher return. And to put things in the perspective, let's say if you look at the micro cap space. Micro cap space is stock number 501 to 750. Generally, the name will give you an impression that micro cap is very small. But you'll be surprised to know that an average company size or a market cap of a micro cap company is 7,000 crores. So they are not so micro or small, they're pretty large. But mid and small is where, or even micro, where the opportunity becomes very big. So that is something which I think active fund managers will do well. Second, where I think the active fund managers have a play is also when you invest in a sector or theme particular fund. So for example, let's say you pick up IT as a sector. You want to invest in IT. Let's say IT have corrected, and suddenly, Ruchira, let's say you become very aggressive. You want to invest in IT. Now, one option is you pick up a IT, index fund. The challenge with the index fund is that it will pick up all the stocks of that sector, and it will also pick up in proportion of what the market cap of those companies is in those sector. Now, since in a given sector there are very few stocks, all the stocks gets picked up, even if they are not good. And, some stocks you may want to avoid, because let's say in IT there are 20, 30 companies and majorly let's say 10 stocks. So a lot of time this problem comes. So that's where I think in a sector or thematic, active funds may have a better chance of doing it, selecting stocks. So I think in sector, theme-based active has a role to play. Third, what I also feel is that in terms of volatility, I think mid-cap, small-cap fund managers are a better play in terms of reducing the risk. And, I think SEBI also has given that mandate. See, typically a mid-cap or a small-cap fund, active fund, they have a mandate of investing only 65% in a mid-cap stock, or a small-cap fund have a mandate of investing only in 65%. So they have mandate of 35%, they can invest anywhere. So last year, when there was a bull run running, we were talking these fund managers and we were seeing that they are underperforming. And we were asking why, you guys are underperforming, and they're sitting on the large cap. And within, the mid and small also, when we used to talk to them, they used to say that we have picked up stocks which are low beta, which are relatively safe in that category, because they were seeing the valuations were high. And now if you look at the return of last 1 year, when market, let's say, especially in the small cap index is the worst performer. And historically, see, Ruchira, what happens is that in a bull run, index will be always the best performer. Active fund managers will mostly underperform, because in an index, you have even smaller stocks which are not of quality. And when they're not of quality, they also go up a lot more. And similarly, in a bear market, when market falls, the indexes, they perform a lot worse. So I think, I've told you 3 pockets, especially mid and small, sector thematic, and even in volatile times, the active funds have value to play, especially in an emerging market. And see, in India, the active funds the passive funds are relatively new, but you have other geographies where the passive funds have been there and the market share is only 15%. So I feel the active funds, the market share will come down and passive will become bigger. It will be interesting to see that at what level they go to.
Right. While, as you mentioned, index funds in India, they are relatively new as compared to developed markets. Many investors, they are now, they're now trying out with a blended approach. So can you explain the core satellite approach and how it helps balance active and passive strategies?
So, Ruchira, if you ask me, Indian investors are generally very smart. And that's what we are seeing. And thanks to the platform like yours, which even Value Research and everyone, they do phenomenal job in providing information and transparently giving information and communicating the situation, the developments. And I think that has already started reflecting in the investors' portfolio. So there has been a lot of awareness about index funds and the advantage in terms of cost which they bring to the table. And that's why we are seeing a lot of incremental flows in the index funds. Now, what I want to tell to people is that this is not a debate whether active is better or passive is better. They both have their own place. It's like creating a cricket team where everyone have their own place. And so I feel that when creating a portfolio, a blended approach or a core or satellite strategy may be right. In fact, I'll give you an example. Let's say you want to eat a North Indian today. If you want to play a safe, then you can order a thali from Haldiram. You will have you will be sure that you will have a good experience. It won't be bad experience. You won't have a very great experience, but you won't be disappointed, and it will come at a decent cost. It won't be very expensive. But let's say if you want to try something, you want to have a great experience, then you will go to some boutique restaurant or some known restaurant, which will of course charge you premium. But there's a probability you may have a great experience as well. And there will be days when, the experience will be very bad despite paying high. So I think even in investing, you have same, like passive funds are like your thali. You won't be disappointed. And so I believe that as a core part of the portfolio, people should have passive funds. And my recommendation will be that at least 35 to 40% of the portfolio should be in passive funds. And, especially looking at the large cap, I think, core, when I generally talk to people, is core and satellite. Large caps constitutes the core because they surprise investors less. On the downside, they fall less and give you decent return. They don't disappoint. So I think for core, passive funds of 35-40% is a good allocation. And for mid and small, or if you have, sector theme in mind, then I think over there, the active will be better, where you can experiment. So, you have it's like going to a boutique restaurant where there's a chance of having a better experience. But so I think that's what a good mix for blended, what investors can look at.
Right. Siddhant, one last question. A lot of investors, they still think that passive funds, they are rigid, while active funds are better, somehow better. What do you have to say to that argument?
Well, I would say that most of the investors carry like these preconceived notions, which keeps them from making smarter decisions. So, in my belief, I think there are three beliefs that investors generally have. First one being that the passive funds are rigid. Well, not really, because when you see passive doesn't mean that your portfolio is static. Instead, it is like your portfolio is rebalancing on a rule-based setting. So it is on an autopilot where they are mirroring the index, and the index in itself is not static, it's evolving constantly. Be it weights, be it sectors, be it other scenarios by which stocks are constantly exiting and entering the index based on that rule that the index has set. So because of that, passives doesn't mean that your portfolio is static, it's dynamic. Secondly, if you see, the second big misconception is that the active funds are always better. So I would say, with our discussion that we had in the last 10-15 minutes, it's quite, we have put that point that no, active is not better always, especially in the counters which are less researched. So I would just like to reiterate that active funds are not okay for large caps, mid caps, or the spaces where the research is already very high, and there is a good chance that your benchmark would beat active fund managers. There is one more misconception that I often hear amongst investors, that passive investing is only for beginners. Well, I would say it's a very naive way to think about it. And as Mr. Jindal told us in the very introductory question, that globally, what is the footprint of passives? And we have seen that it's massive, from pension funds to endowment funds, and globally, big investors are actually pouring in their money and having a good part of passives in their portfolio. So I don't think that this is a right way to think that passives are only for beginners or something. So to sum up, I would just say that passive investing isn't inflexible, active investing isn't bad, and the real advantage of building a mutual fund portfolio is knowing what you are having, and like whatever mode you want to go, active or passive. And if you ask me, I would say have a blend of both. And it was very well put by Mr. Jindal that why and how you should do that.
In fact, I would like to add something, Ruchira, on this. So, we have been doing passive for our clients for almost 10 years now. And I've been personally a big believer of passives in our clients' portfolio. Now, one common theme, what we hear from our clients, which is a misconception, which Siddhant also highlighted, is that, passives are boring. We have added Nifty, because earlier we added Nifty a lot because that was the only low-cost index fund which was available. Now, of course, you have a variety of choice.
You have a buffet now.
Yeah, you have a buffet. So one big complaint which we used to get with the client, they want excitement. And I have common theme to tell to them, all of them, that, for excitement, you can create 10-20% of the portfolio, where you can try and have excitement. But, in the core and satellite, let your investments be boring, because that's where the, good return will come. So I think gradually investors will also learn. And thankfully now the mutual fund industry has also diversified the type of, index funds you have. In fact, some of the index funds which they've come out with are very interesting, very aggressive, and like momentum as a strategy is very aggressive. Even a micro cap. So a lot of time the themes which they are providing or they are planning to provide is not even available in the market. So I think it's a lot of misconception, and as India grows, as mutual fund industry grows, I think the space is only going to become bigger.
Well, that's a great note to end on. Thank you both of you for joining in and sharing your insights.
Thank you so much, Ruchira. Thank you, Siddhant. It was good meeting you.
Thank you, ma'am. Thank you, Mr. Jindal, for joining us today.
And if there's one takeaway, it's this: beating the market isn't easy, but joining in, staying consistent, and keeping the costs low, that can take you a long way. That's it for this episode of Index Investor. Don't forget to like, share, and subscribe for more smart conversations that help you invest better